the back? All right. So welcome. My name is Don Wenner. I'm the CEO and founder of DLP. Thank you for joining us here tonight. Anybody who's here for the first time, raise your hand if you're here for the first time. All right, about half the room. Yes, so welcome. Thank you. Welcome. So, I'm going to start off with acknowledging the people who've been here many times. Make sure you notice here, as I go through this, you'll see a lot of our people in the room have these little pins somewhere on their shirts. And the pins will tell you if they're an investor with us, and if they've been here for a year, 2 years, 3 years. So there should be investors with you at every table in this room. So make sure you talk to them. I'm going to try to give you a great presentation here tonight, get you excited and interested in what we do. But they're going to do a much better job of telling you about how we actually perform, how it is working with us. We have in the room tonight 44 investors who've been with us for less than 1 year. We have 39 investors who've been with us for 2+ years, or at least 1+ year, 15 investors who've been with us for at least 2 years, and then 8 investors who've been with us for 3+ years. So round of applause to all of them. Oh, you're good? All right. Excellent. So what we're going to do here tonight is if you look through those brochures and this is your first time hearing about us, it can seem like we do a lot of things, seem a little bit complicated. We try to break it down here and simplify a little bit of what our approach is, how we do it, how we generate these great returns. So I look at the world of investing sort of as 2 parts. One is the strategy that you're investing in is critical. It has to be a strategy that works. And 2 is the manager, or the ability to execute on that strategy. So I'm going to start off with telling you a little bit about DLP, how we operate, how we're able to do what our investment funds do, how we generate these returns. And then I'll get into the different strategies. I'm going to break it down really into 2 strategies that we do, how you can participate as an investor, and what you would expect in working with us. So, as I just said, first we're going to talk about the manager, second about the strategy. So a little bit about DLP. Some of you may have heard of us before you knew about our capital management. You may have heard of DLP Realty. That's how we got started about 10 years ago. We're the #1 real estate team in the state of Pennsylvania. We sold 1,126 homes in the Lehigh Valley last year. Basically 1 in every 6 homes that sell, we sell. You see our signs probably everywhere if you live here in the Valley. DLP Realty is one of our family of companies, as you'll see on the screen. These are all the different brands and companies that we own. These are all also in those brochures that you have in front of you too. And to prep everybody, we're recording this here dinner tonight. We're live streaming this on YouTube and Facebook. So hello everybody online. So you can also watch this later as well if you're interested. And we may zoom around the room a little bit, so feel free to check your hair and your makeup. You may be on the screen here for a little bit. So tell you a little bit about how we do all the things that we do. I'm going to first talk about our team here briefly. We have an executive team of 4 great leaders. Myself, Bob Peterson. Where are you at, Bob? Here he is. So Bob's our CFO. You'll hear a little bit more about Bob in a little bit. Yes, he's incredibly important. He's the one that actually makes sure that we generate these returns and we get you paid. Jason, whose wife actually, just like my wife, was actually sick and had to head home a couple hours ago. Jason's our Senior Vice President of Property Management, oversees our property management company. And Jim Scherer, who I'm going to introduce in a moment here in the back, who is Jason's #2, who just joined us, one of our newest additions, is overseeing our multifamily real estate. Came up from Florida to join us here tonight. So any of our investors, you probably have not met Jim yet. No, actually, no, you haven't. So make sure you get a chance to chat with Jim tonight. I'm sure you'll be impressed. And then Larry Greenberg runs our construction company. He used to own Hanover Homes for about 30 years here in the Lehigh Valley. One of the largest home builders. He's been with us for about 4 years. He's actually on vacation right now as well. So those are some of our great leaders. What we manage as an executive team is about $240 million in assets. That's over 2,000 homes, apartments, and commercial units. Over 200 loans. Total of 7 funds that we manage, 265 investors now. Last time we did one of these dinners, we had about 230 investors. We now have 265. We've had 0 principal losses on any of our investments to any investor. We've had 0 months where we've ever missed a fixed return or a preferred return. So a fixed return is a return that we're signing a contract with you that we guarantee to pay you. A preferred return is just the return that you earn before we get to earn anything. It's not a guaranteed return. Yet we've never missed the preferred return on any of our funds on even a singular month. That just talks about the consistency of what we do. We now have 182 employees, and we do a total across our companies of about $100 million in revenue. 5 core companies, or 4 core companies here that work together are DLP Capital Advisors, which is the fund management, investment management company that you're hearing about tonight. Direct Lending Partner is our lending company, how we make loans to real estate investors. DLP Acquisitions is the brand that we market ourselves under, and we're buying property, we're acquiring property. DLP Builders is our construction company. DLP Realty is a real estate brokerage, and no surprise, DLP Property Management is our property management company. Those are 6 companies that all work together to generate the results and the returns that you're going to hear about tonight. So I'll tell you a little bit of how we got here. So I've been in real estate now for about 11 years, started back in 2006, 2007. From 2007 to 2014, we flipped about 500 homes. So, home flipping like you see on HGTV, we bought distressed homes, renovated them, resold them. We did a lot of that for years through the downturn of the real estate market, through what a lot of people call the worst real estate market in history. We purchased a total of over 800 homes, apartment properties, office buildings, and lands, and we grew to the #1 real estate team in Pennsylvania, New Jersey over that time. And we started growing as a fund manager. By the end of 2014, we were managing 3 investment funds. And one day, we were sitting there in our office and realized we had about 40 to 50 houses under construction all over from the Poconos down through Bucks County, out to New Jersey. And we would have about, at this point, we had about 90 full-time employees in our construction company, about 150, 200 subcontractors working for us. So we had 250, 300 contractors working on our properties every single day, scattered all over the place from a 100-mile radius. And we said, how do we keep growing? We had all this investor capital wanting to keep coming in with us. How do we scale? How do we grow? You can't really manage and put 500 homes at a time. You actually start losing efficiency. So that's when we really realized we could leverage our property management, our real estate brokerage, our construction company, our capital, all of our knowledge, relationships, and start growing as a multi-family investor. Go from buying houses to buying 100+ unit apartment communities. And around 2014 is when we really started focusing on doing that in order to gain scale. So from 2014 to 2016, our property management grew by over 1,000%. Our units that we owned, our properties we owned, grew by over 1,000%. We started building 2 subdivisions, including 139-unit townhome development we're building right now in Stroud Township in the Poconos. We grew to the #8 real estate team in the U.S. We grew to about 150 employees. So continuing to fast forward to today, we've now continued, as we said before, we get our returns every month. We now manage 5 funds. We've had 0 losses to investors, and we're now up to actually $240 million in assets. And we've been one of the 5,000 fastest growing companies in 5 straight years. In addition to growing as a multi-family operator, we also realized, well, we have all this experience in single family. How do we leverage this? And that's when we started lending to real estate investors as well. We said, instead of having to be the operator doing all the hard work of renovating every home, why don't we provide the education, the knowledge, and the money to other real estate investors who are flipping houses? And that's been our other strategy we focus on. So today, what you're going to mainly hear about is 2 things we do. We buy 50, 100, 200 unit apartment buildings, and we make loans to real estate investors, mainly to flip houses. So those are the main strategies we operate today. By 2025, you might be saying, all right, you've done all this, you have $240 million in assets, you have all these investors, all this thing. Why did you take us all out to dinner and buy us all drinks and fill this room? Well, because we're still growing. So we're at $240 million in assets, closing in on $250 million. We expect to grow to $2 billion in assets by 2025, $1 billion in real estate we own, and $1 billion in real estate loans that we own. And in addition to growing to over $1 billion in capital that we manage for investors like you and including you in our investment funds. What drives us in doing all this are our core values: positive enthusiasm, drive for greatness, grit, delivering wow. These our 8 core values are listed in those brochures we have. These are really the values that drive us and how we hire, how we attract the best talent, and how we grow and deliver great results. So, DLP Capital Advisors, leverages all these companies, all the things we do. I'll tell you a quick bit about myself and then move on to the rest of my team. Again, I've been doing this 11 years. I've closing in on 6,000 real estate transactions, including about 1,000 transactions as the investor, acquiring close to 1,000 properties. I'm the founder and CEO of the family of DLP companies. Most importantly, I have a beautiful wife, closing in on 7 years, who's homesick right now, and 2 little boys, Donnie and Alex, who are Donnie's starting kindergarten next month, and Alex is starting BBK. And we own a total of about 400 properties right now with our investors, single-family homes, apartment communities, commercial assets, and so on. So 2 important people who work with me are Bob Peterson and Barry DeGroat. They're both partners at DLP Capital Advisors. Bob's our CFO, 35 plus years in financial management, 20 plus years as a CFO, previously for a company much larger than us, running a very similar role. Barry DeGroat, our general counsel, oversees and manages our risk across all of our companies. Also a real estate broker, background in land development. 2 key instrumental people in our success and what we do. And I encourage you to talk to these gentlemen who are both here tonight and hear more about their stories and how they help make everything we do happen. So for us, it's all about teamwork. You'll see some of the rest of our great leadership team here at DLP Capital. Many of you know Larry Hickornell, probably spoke to him back here. Where's Larry at? There in the back, there he is. In the back here. Mandy, who coordinates these great events and makes everything happen and makes me be able to just show up here right before the event starts and get on stage. The rest of our great team. Pat does all the analysis and analyzes all the risk on every property we buy, every loan we make. Matt Johns, our newest addition to our team, he's our controller. I think he's around here somewhere. Where's Matt at? There he is, in the back there. So Matt's our controller. He's Bob's number 2. Helping lead our accounting team, about 15, 16 great in-house accountants. Samantha's the one who actually makes sure your distributions go out, so she's pretty important. It's a great growing team, as you can see here. We can say with confidence, we're institutional in quality. We have third-party audits on the income and growth fund and the lending fund now for 3+ years. We're an approved investment option for registered investment advisory firms. You can invest with us through 94% of the major brokerage custodial platforms, Charles Schwab, Fidelity, TD. You can invest right through your brokerage custodial platform with us, which is a big deal. We've now been approved with these firms for closing in on 2 years. Where we operate, these are where our offices are located. So our headquarters of our company, and a few of you asked me today, with all of our growth in Florida, is this changing? Short answer is no. Over 100+ of our employees work right here in Bethlehem. 701 West Broad Street, a few blocks up from downtown. That's our headquarters of our company. We have a small office in Doylestown as well. We have a beautiful office up in the Poconos. It used to be the LTS home buildings. As you see, we have an office now in Parsippany, New Jersey, which is new for us. We just opened the office in St. Augustine Beach there in the bottom, right along the beach, which also has a beautiful guest suite, as some of our investors heard earlier tonight, for our investors to be able to come down and stay and soak up some Florida sun. We have another office in the north end of St. Augustine, Florida. And then we have a property management south headquarters in Daytona Beach, Florida, as well. So those are our 7 offices. In addition, we have employees working at communities throughout North Carolina, South Carolina, Georgia, and other parts of Florida as well. Here's the most important part of us and everything we do is our investors. We have 265 investors, as you can see. You'll see a breakdown on the right of how many investors are in multiple funds with us. We now have over 50 investors who have at least 2 different fund investments with us. They invest in multiple funds with us. Many have invested with us IRA accounts, cash accounts, kids accounts, parents accounts, etc. All of our assets are spread, as you can kind of see, and these are in the brochures as well. As you start seeing, as we're filling out the middle of the state there, we invest up and down the East Coast, mainly the Southeast and Northeast, and we're making loans from Connecticut down to Florida. The left is all of our properties and loans. The middle is just the properties. The right are just our loans. And you'll start seeing as you come to these dinners and look at our materials, the Georgia, the Carolinas start filling out more and more as we have a lot of activities going on in those states. This is a little hard to read, I know, on the screen, but again, it's in the brochure. This gives you a breakdown based on the amount of capital, where all of our capital is invested by state. as well as by type of property, single family, multifamily, commercial. Right now, 45% of all of our money is in single family housing, 40% is in multifamily, and 15% in commercial properties. As we grow, that multifamily percentage we expect to continue to grow. This is just our loans. Right now, our loans are pretty well spread out across a lot of states. 36% in Pennsylvania, 33% in New Jersey, 21% in Florida, and then small percentages in a bunch of other states as well. So why DLP Capital Advisors? So a little quote here, if you can't read it, says, there's only one sound investment, put all your bones into real estate. So what we do is we invest in real estate. Again, we've got a track record now of 7-8 years. We've done thousands of transactions. We have the size, the market knowledge, the real estate brokerage in-house, access to deals that make it an ideal situation to work with us versus going out there and executing in the real estate strategies on your own, which many of our investors do in addition to working with us. Because of our size now, we're able to attract the best talent internally. We're able to get the best discounts from suppliers. We're able to have the right infrastructure, risk management, right technology, right tools, things like the new DLP Crowd portal that we just rolled out Friday, institutional quality investor portal for you to get access to your investments. And we run sound investment strategies that work. We buy great deals at the right price. We make sound investments on loans. You'll read as you go through those brochures a lot of our risk management strategies, how we mitigate risk in making loans, how we mitigate risk, and how we buy multifamily. I'm not going to cover all that here now, but I'll touch on a few of those big points here in a moment. So show me the money, right? So I gave you a little overview of what we do, how we do it, who's involved. Let me tell you a little bit about the strategies and then how we pay you as investors. So private lending to real estate investors. So the DLP Lending Fund and the DLP Income and Growth Fund both operate in space of making loans to real estate investors. What's created this opportunity is banking regulations. Who's tried to get a loan from a bank anytime in the last few years and realized how much fun that is, right? It's not a lot of fun. Banks move slow. There's a lot of regulations. It was one of the biggest hot topics in the political environment, right, is repealing a lot of these regulations and slowdowns. It's made it very hard for banks to lend on real estate, specifically lend on short-term loans on speculative or distressed real estate. In addition, our average investor, when they come to us, our average borrower, I should say, come to us with only about 15 days to close. Try getting a bank to close a loan in 15 days. Because of things like appraisal fraud that happened in the downturn, banks have to hire. If you wanted to go to a bank to get a loan, you could, I say this, you have a bank where you have $5 million in that bank in deposit. And you could come to them and say, I'm buying a property for $1 million, and I'm going to put down $900,000 cash. I just want a $100,000 loan. You won't close that loan in less than 45 days. It's going to take them 3 or 4 weeks just to get the appraisal ordered back. It'll take a week to order the appraisal bids, then send them to you to decide, 3 weeks for the appraisal to come back, a week for them to review the appraisal in-house, and then maybe they'll get you on loan committee in the next 2 weeks, and then they'll send it over to the legal department after that. That's how it works. So there's a big need for speed, which is what our investors need. They're buying foreclosed deals, distressed deals, but they got to be able to execute, know the money's going to be there, and they can close quickly. We're also in an environment, even though foreclosures have been on the decline, there's not nearly as much as there used to be, we still are in a country with aging housing stock. Right? Most of you probably know this, that other than a few select markets like St. Augustine, Florida, where there's a lot of new construction, most of the country, there's not a lot of new construction. So there's not a lot of new housing. Housing is getting older. So as housing gets older, it ages. Houses need new roofs. They need updated kitchens, updated bathrooms. Housing stock is getting older. So that creates an opportunity to renovate homes, which is what our investors are doing. There's a constant opportunity to repair, beat up homes, and that's something that's here in all markets, regardless of foreclosures or not. Another great reason that there's this environment's here, one of the great parts of this strategy, is our loans are short-term in duration. We're not like a bank where we're making 30-year loans or 20-year loans. Our loans are typically 6 months, which means we're not stuck in a loan if the real estate market's going down. Our loans are short-term in duration, which banks aren't interested in doing. So we help investors come in, provide them the capital they need to buy real estate, renovate it. That in turn improves neighborhoods. It drives local economies, provides jobs, and then we're also able to help through this provide turnkey housing to renters and to home buyers. That's the good side of home flippers is they're improving neighborhoods, they're improving housing, they're providing great renovated, up-to-code housing for people. So we make short-term loans to these real estate investors, first position loans backed by real estate at an average loan to value of 54%, at an average loan to cost of 73%, at an average interest rate of a little over 13%. Our team that helps us do this, you'll see here on the screen some of the same familiar faces, some other great leaders who make this happen. Brian Yarnell's here in the room, who's been helping us grow our lending business, also my partner in our marketing company, and some of our other great funding specialists and leaders as well. Some more of our great team here as well. So we make loans to real estate investors, not to this guy. It says, my sister never did get the hang of flipping houses as a wish underneath the house. We're not lending to the rookie watching HGTV, trying to flip his first house. We certainly try to help educate new investors, but most of our investors are guys doing this full-time, professionally, buying 10, 15, 20, 30, 40 houses a year. We just signed up an investor who does 700 house purchases a year. 700. So we lend experienced guys. The average net worth is about $2 million. Average liquidity of over $150,000, close to a 700 average credit score. Good quality, experienced investors who come to us, pay us 13% because of our speed, our execution, the fact that we have access to capital, and the fact that we bring them a lot of knowledge, resources. We help them find deals. We help them with contractors. We help them sell the real estate, do market analysis, etc. So again, as I mentioned, 54% average loan to value. Talks about how we do that. We get third-party appraisals. We do another third-party evaluation through a system called Red Bell that gives us another set of value on top of a third-party appraisal. We do our own internal valuation on every loan. We also focus on, I'm a big believer that cash is king. So in the world of lending, and some of you have probably heard me say this before in the past, but in the world of lending, in the downturn of the market, when there were about 10 million homes that foreclosed, at least, from 2008 through current, right? Through this downturn in the market. Anybody surprised to hear that 10 million plus homes foreclosed? Right? Probably not, right? We all might have thought it was higher, right? And it is over 10 million. So who wants to take a guess? And existing investors have heard this before. Be quiet. So anybody new here? So who wants to take a guess at how many of those 10 million plus foreclosures the borrower of that home put 20% down of their own money? Zero? Not many. Not many? Very little, right? It was under 10,000. So very, very small, less than 0.1%. So we're a huge believer that when people put 20% of their own money down, they pay. It's magical how it happens, right? Lending used to be very simple. You go to the bank, you're 20, 25% down, bank shakes your hand and they give you the other 75, 80, right? And they know you're going to pay because you put your own money down. So we do all the full underwriting a bank does, and we check tax returns and pay stubs and liquidity, and we do background checks and credit checks. We go out and physically check the property and inspect it, and a whole lot of things. But at the end of the day, it comes down to one core principle, which is that they put their own money into the property. And that mitigates risk. That's avoid us from losing any money on any loan and having very little default. Right now, we have 4 borrowers in default over 30 days. Very low amount of default because we're putting a lot of cash in. Even when there is default, we're typically not worried about losing money on the loan because we have a 54% loan to cost on average. We have a lot of equity. We get full title insurance, hazard insurance. We have full-time insurance expert in-house who reviews the hazard insurance policy. We hold back all of the rehab funds. So when they come to us, they need to invest $50,000 into renovating the house. We hold that money back. We don't give it to them when they buy the house. We give it to them after they do the work. Every time they complete work, they contact us, and we go out and physically inspect that property to make sure the work's done before we release money to them. So again, we lend to strong borrowers. We inspect the properties. The gentleman who ran our construction company for about 5 years oversees every inspection, and we use a third-party inspection agency in states like Georgia and the Carolinas. But our director of inspections reviews every one of those reports and evaluates what we release. Again, we have a lot of third-party partners who validate our values, who help make sure nothing's falling through the cracks. So that's our lending strategy. Our multifamily strategy is buying properties, buying multifamily properties, buying B and C class apartments, buying apartments built in the 1960s, 1970s, 1980s. Not the brand new, beautiful luxury apartments that have elevators and fitness centers. The apartments that are typically 20, 30, 40 years old, generate strong cash flow, mainly in the Southeast. So our process and how we go about all the work of finding these deals is we look at about 500 deals a month. We take about 50 to 100 of those that we do financial analysis on. We then take about 25 of those that we go out and we actually look at the property, evaluate it. We then put offers out on about 15, 20 properties every month. We end up winning about one auction a month, or one purchase a month out of all that effort. We go out, we walk through 100 apartments or 200 apartments. We go out and we sit down with the property managers and we take the financials they gave us and we actually look at the leases to make sure it matches up and look at their actual past financials. We go out and we talk to the police station and see what the crime's like. We pull crime reports. We go out there and check out the competing communities, talk to the other property managers. We pay for the most comprehensive database in the country called CoStar. We spend thousands of dollars a month. It gives us access to all kinds of data on this asset, on competing assets. We do hundreds of hours of work, and most times for nothing. Most times we don't win the property. But because we put forth all that effort, when we do get a deal, it's a great deal. We're not just going out there and buying deals at market and paying what everybody else is willing to pay. We're putting forth tons of effort to get strong deals. You make money when you buy something, and we're big believers in that. Put a lot of effort into buying the right deals. The type of effort we do here, no matter how much, you can go out there and look on LoopNet, look at these websites and try to go buy an apartment building. No one person can go through and do this process to get the quality of deals we get that we go through it every single time to get a deal. Then once we win an auction, then we go out and we go through even deeper due diligence for weeks and get contractors out there and get roofers out there and put together 40-page roofing reports from drones to see what the roof quality is like and the light level. Just tons and tons of effort to make sure that we're getting strong deals and that we're going to hit our returns confidently. And then after we buy a good deal, it's not a good deal if you don't manage it well. So most property management companies, or most times when property being sold, they're assuming that you're going to keep a 6% vacancy. They're assuming that you're going to have 94% occupancy. They're assuming you're going to be able to run this community with very low repair costs, and that usually doesn't happen. Usually returns aren't as good as you think they're going to be when you buy a property. We actually put in very conservative expectations that are less than how we actually perform. So don't tell my property management team that, because we set very much higher expectations for them, but we set reasonable expectations going into a deal to what we're going to be able to achieve, so we can go out there and exceed that through strong management. We prefer to hire third-party management, no offense, Jim, and not have to do all the work ourselves, but there's no way we can get the performance we get other than us managing it in-house, employing 50-plus people, having maintenance employees at every community, having full-time management staff on site, doing all the heavy lifting of traveling, having regional staffs out traveling to these communities every week, and so forth. And then again, as I said, disciplined buying is a big key to us mitigating risk. And here's a really big one, is long-term non-recourse debt. So most of the loans we place on these properties, we're fixing in our loans for 7 to 10 years with non-recourse, so the bank can't come back after us, and we're locking in those interest rates at today's rate. So even if interest rates go up to 6.5%, 7%, 8% over the course of our investments, our interest rates are locked in, and the terms are actually typically 30 years. So even if rates change, we're still locked in and have our fixed debt, or it can't be called on us, which is a really big deal to lock in that debt, to not be in a situation when we go into the next downturn that we're stuck and we don't have strong financing in place, which is where people often get in trouble in real estate. So we can mitigate risk, yes we can. So I didn't get to see some of these pictures my marketing team put in, so I'm seeing them with you here. This is again some of our great property management team who makes that happen. Some of our performance track record, over 94% effective occupancy, means over 94% of our units are occupied, and here's the big thing, the tenants are paying. So that's a big factor that people often don't think about when it comes to occupancy. Some of the people who make it happen on our construction company side, a little more information on realty and so forth. So, and then here's some faces you might know. Bobby Gunther Walsh, as many of you know, endorses us. In Florida, some of you hear us with Rich Jones. We're also endorsed by Glenn Beck, Sean Anthony. So let's talk about the funds. I gave you a lot of information about us, how we do the things we do. I'm going to try to simplify the strategies we offer here a little bit. So DLP Lending Fund. This is the fund that strictly makes loans to real estate investors. Here's how it works for you as an investor. The goal of this fund is to distribute an 11% net return to investors. That's with all income being distributed out monthly. So that's not us factoring in any unrealized gains or improving the value of something. That's actual returns that are generated and distributed every month. The preferred return is 10%. That means you earn 10% before we earn anything. With an overall return target of at least 11, all distributions are monthly, 90-day redemption clause. You can redeem your investment in 90 days. So compared to typical real estate investment, highly liquid in nature. You can invest through a brokerage account. You can invest through your IRA. It's a great investment to use qualified money on. Or if you can shelter double-digit returns from tax, pretty amazing way to do it. Here's our historical track. I know this is hard to read, but this is in your brochures. Historically, in the lending fund, this is our 4th year. We've averaged 15.02% net returns to investors. Our worst month was 12.33% annualized net return to investors, paid out and distributed each and every month. You can choose to compound if you don't want the distributions. It'll compound and reinvest every month into additional units, or you can take the distributions, your choice. So all we're doing here is making loans, 54% average loan to value, 73% average loan to cost to real estate investors to purchase mainly single family homes. Here's a breakdown again of where our loans are located. Here's some case studies of our loans. Just to give you a couple really quick examples, and again, these are in your brochures. This loan was $222,000 on a property in Phoenixville. The value was $360,000. Loan to value was 62%. Loan to cost was 82%. Borrower had a 754 credit score, and the wife had a 675 credit score. Our interest rate was 13.2%, and they actually ended up selling the property for $435,000. We valued it at $360,000. In Penargil, right around, not far from here, we made a loan of $66,000. Value was $115,000. Our loan to value was 57%. Our loan to cost was 75%. Borrowed a 728 credit score, a $450,000 net worth, 12% interest rate, and they sold it for $30,000 over our estimated value within 6 months. Another one in Florida, $80,000 loan, $140,000 value, 57% loan to value, 72% loan to cost. We had 4 guarantors on this loan: a 716, a 706, a 674, and a 605 credit scores. Interest rate of 14.99%. We estimated the value of $140. They sold it for $155. These are some of the actual loans that have paid off in the last quarter. Another one in Philadelphia. So there's some examples. The DLP Income and Growth Fund, I'm going to make it simple here. This is going to look like the exact last slide I just showed you. The DLP Lending Fund and the DLP Income and Growth Fund are very, very similar. There's two different just to mention. Number one, the DLP Income and Growth Fund will make loans to real estate investors, loans to properties that DLP buys. So it can make loans as well as to other investors. And then this fund pays out the preferred return of 10% monthly, and it pays out the returns over 10% quarterly, while the lending fund pays everything out monthly. But otherwise, same 11% return target, 10% preferred return, 90-day redemption language, making loans to real estate investors. This fund has a track record of this fund's only 6 quarters long, been open for 6 quarters. The net return this past quarter was 12.28. Return since inception was 12.63. We expect looking for next year, I think we'll average right about 13%. In the DLP Income and Growth Fund, you can also invest as a note holder. I should mention that everything I'm talking about tonight, other than what I'm about to show you, is for accredited investors only. Meaning you have to have $1 million in total net worth or a $200,000 annual income. Non-accredited investors can do SMA notes with us, or do a private note with us. And accredited investors can do so as well within the Income and Growth Fund. Both options is the same interest rate. So we pay out a 6.5% to a 10% fixed return on your investment. Depending on how long you invest, you can commit for 1 year, 3 years, or 5 years. You can invest anywhere from $100,000 on up. The interest rate goes up as the amount goes up and as the commitment goes longer. You're wondering why there's 2 different slides here. On the left shows if you take your distributions every month, which you're able to do. The right shows if you let it compound and grow, what the compounded return works out to be. So you can choose to take distributions every month or let it compound and grow. You can switch it in. All of our investments you can invest through IRA accounts or, of course, non-IRA, non-qualified money. So we're big believers in the power of consistent returns. We're all about all of our strategies generating consistent returns month in and month out, quarter in and quarter out, avoiding principal loss. One of the smartest investment sayings I ever heard was, the best way to make money is not to lose money, right? Pretty true, right? You can make 10% year after year, and then if you use 20% of your principal, it takes you 3-4 years to make that back and just get back to where you started, right? So we're big believers in the power of compounding returns. Warren Buffett, when asked why he's so wealthy, he said, because I live in America for great opportunities, I have great genes to live a long time in compounding returns or compounding interest. Consistent returns again and again, not having big ups and downs is what it comes down to. That's how all of our strategies are focused on. Our consistency of protecting principal is our #1 focus. Generating consistent returns is #2. Generating high yield returns is #3 in our priority list. So why do a fixed return note? The return's fixed. So we sign a contract with you. It's not guaranteed by the FDIC, but it's guaranteed by us. We're signing a contract with you, guaranteeing to pay you back all your investment for 5 years, whatever you choose, and guaranteeing you that fixed return. It's the lowest risk of any DLP investment as well. So in our quote-unquote capital stack, you're at the lowest. You're first to get paid as the note holder. This is an example of a recent investment we made in the Income and Growth Fund, which is a 128-unit apartment community in Brunswick, Georgia. Again, all of our investment strategies, you can utilize your IRA. This quote here became recent: "I'm going to retire and live off my savings. What I'll do the second day, I have no idea." We work with you to plan out your retirement and set up consistent returns that you're not having to pull out your nest egg to support your living. So lastly, I'm going to talk about the DLP Equity Fund 2. This is our newest fund. We opened this at the end of March. This is the fund that invests in the multifamily real estate. This fund owns apartments. It will end up owning at least a couple thousand apartments. By next week, it'll own about 300 apartments. So we're mainly buying 50 to 300 unit apartments. I know you probably can't read that. Again, it's in the brochure. We're buying properties that we can generate at least a 9% plus cap rate within 1 year of purchase, and at least a 12% cash on cash return. That's cash flow just coming off of rental income, not factoring in the increase in value, not factoring in paying down the mortgage, just the rental income we're generating regardless of the value. We like to buy distressed situations. As I said, we take a lot of effort to try to underwrite deals. Most of the deals we end up buying are something like this: must sell, lost job, can't pay mortgage, wife left, took dog, house is a jam except for the asbestos. Best offer, right? So we end up buying stuff that requires a lot of work, or coming in there and renovating apartments, poor management, things like that. That's how we get the kind of returns we're getting, because we're willing to do the hard work. We add value by often renovating the properties. This is an actual unit that's pretty much the prototypical unit in a lot of our communities that we buy, which is a type of apartment called a cardinal apartment. And this is usually what they look like when you get in: wallpaper. There's always exhaust venting issues, dated kitchens. There's always issues with the joists and the support underneath these kitchens, as this picture showing. Wallpaper, neglect exterior, neglect interior. And then we come in there and put in new kitchens, hard surface flooring, vent out the exhaust correctly, get rid of mold issues, make the apartments nice, fresh, clean, attracts better quality tenants, allows us to increase the rents and keep tenants much longer, which is the name of the game. As Dr. Stan and myself were talking about right before the meeting, the #1 challenge in real estate. He owns 100 or so apartments here in the Valley, and is turnover. Dr. What is turnover? It's the biggest cost in the world of real estate, and we focus on keeping our tenants and our properties for a long time, and it's a big part of that. So why multifamily? Well, rentership is on the rise, if you don't know that. Homeownership went from 69% down to 61% over the past 8 or 9 years. Most are expecting that to continue. People are getting married later. Average age somebody gets married now is 36, 37 years old. Average age somebody buys their first house now is 37 years old. So people are starting family formation later. They're being renters longer. We're in a society where people are changing jobs more often, wanting more flexibility. The dream of homeownership is on the decline. That's the reality we're in. Rentership is drastically on the incline, which is what makes rentals apartments so great. Why we invest in B and C class apartments versus buying the beautiful brand new 2015 built apartment community with 4 stories with an elevator and a pool and a clubhouse is because, number one, the returns are way better. You get better cash flow. The properties are in general less attractive to big institutional money. But what we really like about these properties is think about this. So right now, would everybody agree, whether there's a strong foundation behind it or not, that right now the general feeling is that we're in a good economy right now? People say that, right? Better economy, right? Rents are growing. Rents have been going up a lot of markets, 8–10% a year. Real estate values are going up. We can argue about the underpinnings, but things are going up right now, right? So when we go into the next recession, who thinks property values and we'll go into recession again at some point? Right? At some point, right? It's going to happen, right? It happens again and again. So when that happens again, right now you live in a $1,500 a month, 1-bedroom apartment in Jacksonville, Florida, with the beautiful clubhouse and the elevator and so forth, which the average 1-bedroom is about $1,600 in Jacksonville, Florida. And you lose your job, or you're a husband and a wife and one loses your job. What do? I know the news likes to tell you that everybody moves back with mom and dad, but that's not the reality. Most people don't have the option to move back with mom and dad. It's not what everybody does, right? So you have to go somewhere affordable. So we own the properties in the communities where the average 1-bedroom is $700–800. In the same community, yes, it might not have all the same amenities, but it's nice, it's clean, the apartments are well kept, it's well managed, it's safe. So we believe when we go through the next recession, that occupancy is going to remain really strong in apartments, in these types of apartments, because there's always a need for affordable housing. Since 2012, in the entire United States of America, there has not been one market apartment community built that is not Class A. Meaning every single property being built is the luxury properties, which means there are no affordable housing being created. Typically what happens is the properties built in the 1990s would now start being lower grade apartments. They'd be what would be called a B class. And the rents wouldn't be as high as the brand new apartment. Because there's so much money in real estate right now, people are buying those nice 1990s apartments and they keep renovating them. And they keep improving them, so they keep those rents up. There's so much money pushing those properties up. And in a lot of markets, you have 1,500 and you have 700 and nothing in between. There's not, the affordable housing is disappearing in many markets. So why we think the strategy is going to remain really strong for a long time. Again, no new supply going on. So this is the first property we bought in the Equity Fund 2. It's a 96-unit apartment community, 2-story garden style block apartment community in Titusville, Florida, the Space Coast. The property we bought, pretty good occupancy, but poor management, low rents. Does have a pool. So not all of our communities have no amenities. Some have pools and clubhouses, but not nearly, of course, nice as a brand new community. There's some examples of floor plans. We have 3 different floor plans. This is an example of the quality of the units. So it's in good shape, but you know, these are renting out for $600 to $800 a month. That's our first property. The next one we buy next week is a 196-unit community in Warner Robins, Georgia. This is 3 different communities next to each other that we're buying in one package. 196 apartments. One's a 1-story, a 2-story, and another 1-story community. This is a property we own in Greensboro, North Carolina, which 7 or 8 investors in this room own this community with us right now, which is this 1-story Cardinal community. This one here is in Jacksonville, Florida, which Tina and Ray, sitting right here, own that community with me in Jacksonville, Florida. That was the first of these types of communities we bought. This is one we own in Daytona Beach, which is 56 units, 2-story. Here's one we own in Jessup, Georgia. So this fund, how you make money as an investor here, what the returns are. 7% preferred return. So you earn 7% before we earn anything. The goal is to distribute to you 8 to 9% returns each year from rental cash flow, paid out quarterly. So about 2% return on your money every quarter just from the rental income. Plus then we're expecting to increase the value of the properties. We're paying down the principal. It's an 8 to 10-year fund. When we turn around and sell the properties at the end, we expect to return back to about 2 times your initial investment, bringing your overall return to about 17% net return to investors. So 17% is very attractive, of course. But what's really attractive is that this is a tax advantageous fund in that those distributions we're paying to you each quarter are predominantly being deferred from tax through depreciation. And then when you take those gains at the end of the fund, if you take those gains at the end of the fund, there's not another option. Most of those gains will be long-term capital gains, which historically no one knows where the tax code will be in 8 to 10 years, but historically is much lower than your marginal tax bracket. Now, right now it would be around 17% versus 30, 33, 35% that many of you are at today. So this is an 8 to 10 year fund again. You can redeem and get out with 180 days notice. This is a fund you go in looking for long-term return, looking for a tax advantageous structure, and looking for the best overall return. So I know you're thinking, wow. So I'm gonna finish up here. Before I go into questions, I'd let you know, please make sure to talk to myself, Larry here tonight. We're gonna be walking around. Feel free to set up if you want to talk further one-on-ones with myself or Larry and our team, or to follow up with more specific questions you have. We're gonna do a raffle here in a minute as well after I open up the questions. Also want to remind you, we're doing an event on November 12th for Valley Youth House. All proceeds go to Valley Youth House, a race. It's a little far out, I know now, it feels like, but it'll be here soon. That we're going to be holding in Bethlehem, half marathon, 5K, fun run. So any of you own companies you want to sponsor us, great, or if you can just come and support us and run, that'd be great. So free food, obviously you all showed up here tonight for free food. The next free food. August 26th will be in Florida. I hope some of you can join us. If you want to come down to Florida, we'll set you up with some housing down there. You can come join us at our next St. Augustine dinner. We'll also have another dinner in Florida in early October, maybe even late September. We're still finalizing our next dinner here in Pennsylvania. Will be October 28th. We'll be recapping the third quarter for our existing investors like we did tonight, earlier before the dinner, and having another dinner like tonight, possibly right here again at Woodstone. Before I do the raffle, I'm going to open it up to questions. Then we're going to do 2 raffles, one for a $100 gift card and one for a week vacation down at our beautiful new condo, which gets finished tomorrow in Amelia Island, Florida. So with that said, I'm going to open it up to questions. Just raise your hand and I'll come around with the mic and take your question. So thank you, everybody. So Larry just reminded me, in order to be in those raffles, you have to fill out these forms. So they're gonna come around after we do questions, and they're gonna grab these forms from you. We're gonna put it in a basket, and we're gonna draw names. So in order to qualify for the gift card or the vacation, you have to fill out this little form and drop it in, and then I'll walk around and have somebody pull out the names and pick the winner. And I have to say, we really do this. So where's Al? There he is. So at our last dinner we did, Al won. And he's heading down to St. Augustine on Saturday to stay in a $1 million plus beach house in St. Augustine with his whole family. So we really do want it. Many of the investors here have actually stayed at our places. So yes, you guys have. Please fill these out. All right, so questions? So Brian's going to come around with the mic. Everybody's more interested in the raffle right now, but all right, here we go. How much money are we managing is the question. So we have about $240 million in total assets. We manage a little under $100 million of investor capital. Which, to give you a quick, I don't know if I covered it here, but we covered it for our investor. Last quarter, we raised $14.5 million in investor capital. The previous quarter was $13 million. This quarter will be over $15 million in capital invested.
Yes, I understand. It's a perspective.
They're not even asking for phone.
Bill.
But how do they know who you are?
Two different apartment complexes here to purchase. One went into the income and growth, and one went into the equity too. How do you decide which you put in which fund?
Great question. So typically, most of the multifamily communities go into equity fund 2, with a couple of caveats. Number 1 is equity fund 2 doesn't have enough money. So that's the really short reason on Merit Landing, is we already had all of our money penciled in for the first purchase and the second purchase that we close next week. So when we got, even though that deal already closed, we had to close that deal in 20 days, no contingencies, no time for even to go to a bank to get financing. We won that through an auction, and we literally closed in 20 days. And all of our money was already placed on the Warner Robins community we're buying next week, which is an $8.3 million purchase. So that's the first reason, that's the main reason. The secondary reason a property wouldn't go into the equity fund 2 is if it needs too much heavy lifting right now. So if it's a property that's not going to generate cash flow for a while, we wouldn't put it in the fund at this point. Maybe once the fund gets bigger and it can handle absorbing a property that's not performing, we could consider it. But this property we bought had 40 apartments that were down, meaning they weren't rentable, have been down for about 10 years, and weren't rentable at this time. So with 40 units down, there's no cash flow. So we'll have good cash flow once you bring those online. but it wasn't able to generate cash flow. But it works for the income and growth fund because we're actually borrowing the money from the income and growth fund, and we're obligated to pay the income and growth fund, I believe in that case, 14% fixed return, regardless of the performance of the property. We're still paying the fund. So we can carry, as the operator, the cash flow while we get that property running effectively.
Now, do you keep that in the fund, and does that come back as equity to that fund, or do you?
It's a good question that we're evaluating right now. So, you know, the short answer is I'd like to say yes. And our approach is, you know, there's no reason we get this property performing well that if we could sell it into the equity fund 2, and I would keep, you know, retain ownership 2 is usually how I've done in equity fund 1, where, you know, I'll keep my own money in that deal as well as the fund. And if we can hit the return targets of the fund and know the property is performing well because we've already been managing, it makes great sense. To be full transparent, right now we're talking to a very large institutional wealth management firm who manages over $5 billion, and they manage money for pension funds and large endowments and so forth. And we're kind of evaluating if they're going to frown upon us selling a property in or not. They, as a fund manager, they say that's great, makes great sense to do, but they don't know if their pension funds will look at you selling a property from another fund in. So we're still trying to figure out if that's going to cause us a challenge with large institutional capital as we grow. We know our investors, you know, we're always transparent when we do those things. We sell them in at great deals. We're very transparent in the cost. Makes great sense, but we're just trying to evaluate if it's going to cause us institutional challenges. It's a great question. I could talk, of course, in more detail with you on that, but that's literally a discussion we just had this past week, Bob and I, with this institutional partner. Yes?
When you sell one of the properties, you ever look at going into a 1031, roll so you don't have to pay a capital gains, just roll it over to another property?
Yeah, great question. So, so the people sitting here behind you chatting, Tina and Ray, they've both done 1031 exchanges with us. A few of our other investors, I don't know any other ones in the room, have done them with us. So if you were, you know, had a property you own right now that you wanted to sell and invest with us, which is a common question people ask us, you can't do it. So let me backwards. A 1031 exchange means you sell a property and you buy a like-kind property, which means the way that you can roll your money into another property and avoid paying tax. So it's a great strategy in real estate to not avoid, but defer paying tax, I should say. So you can't roll into an investment fund, can't sell a property and go into equity fund 2. So what we've done for investors, when an investor comes to me and says, hey, I'm selling a property, I don't want to buy another property, I want to invest passively with you. What we end up doing is having that investor partner with us or partner with the equity fund 2 in what's called a tenants in common partnership, where you'll own a specific property with us or with the fund outside of the fund, but in the same terms as the fund. So it's the way we do it where it qualifies as a like-kind property and you can still become a passive investor. Make sense? So, so that is the way it goes. If you're somebody who owns real estate, you want to get rid of it, but you don't want to pay the tax, we can help you to do so and defer tax, but go passive.
My question is more, when you roll over one of your properties, after 7 or 8 years, one of the properties you buy and you sell it and the fund is ending, rather than people paying the tax, do you ever roll that into a new property and continue the fund?
Yeah, great question. So if within the fund we sold the property, let's say we sold the property during the duration of the fund, yes, we could go buy another property and as long as we're staying in the fund. If we wanted to redeploy that money again, we could. Really, the fund's not going to be structured that we're going to be selling and then rebuying. It's really going to be buying, improving, and selling sort of all at the end. But at the end of the fund, our goal is, we don't have an exact plan for you today, but our expectation is when we get to the end of this fund, when it comes time to sell off all these properties in 6, 7, 8, 9 years, is that we will have an option for you to be able to continue to defer taxes. It won't be a 1031 exchange, but to be able to roll your investment into another investment vehicle with us and continue to defer tax out just like a 1031 exchange, or very similar, I should say. A great question. All the way in the back, making Brian move.
You gave an example earlier of you bought a apartment complex that had 40 units down, and it didn't qualify for your equity 2 fund until it was renovated. So how do you work the deal once it's renovated and get it into equity fund 2?
Great question. So first answer is we don't know if we will or not at this point, due to the previous question about if it be if an institutional pension fund basically will consider it a conflict of interest or not. Is the question that's still outstanding for us to answer. But the answer is if we did do it, we'd have to underwrite the deal to the same standards we would underwrite any acquisition, which we'd have to be able to achieve those financial metrics of the fund, which in short terms means we'd have to sell the property at a discount to the fund, which is what would happen, because we have to sell the property in the fund where we can generate 12+% cash on cash return and 8.5, 9 at least cap rate. On a property like that, I can sell it through the market for a 6 cap rate. So I'd have to be willing, which is something we've historically been willing to, sell at a discount to the fund. But again, we're still, so the verdict's out if we're going to be able to do that in that case, of that property or not. But if we did, that's the standards we would have to do it to. Thank you. Great question, Tom. Good questions. Meg. Oh, no, just quick. Okay, waving somebody else down. That can't be it. This would be the easiest night ever. Everybody's waiting for the raffle. I should have done the question after the raffle. All right, why don't I do that? I'll let you guys think question. I'll answer a couple more if they come up after we do the raffle. Did we go around and collect those yet? All right, so we'll walk around and collect those now. And I guess while we're waiting to collect, I'll stay up and entertain you some other ways. Anybody want me to recap anything? If it's not a specific question, anything that wasn't clear, they want me to recap or go over again while we cut? Yes, there we go.
Your relationship with the
Did they skip us?
like Schwab and Fidelity, and are they actually, as part of their funds, investing in your group of funds, or can you invest through them into your group?
Great question. So his question was, what's our relationship with Charles Schwab and Fidelity, these big broker custodian platforms? So no, they don't invest in us. We are on their platform. So there's an organization called AIP or DTCC, which is an alternative investment platform that all 94% of the big broker custodian platforms work with, manage their alternative investment platform through. It's an organization that takes alternatives and puts them in a structure and formats them for these broker custodial platforms. So we went through a process of getting approved through them to be a quality to get onto these large institutional platforms. So if you went, example, if you had an advisor at Charles Schwab or at Fidelity, he's not going to come to you on his own and say, hey, I really looked at this DLP lending fund and I think you should invest in this strategy. Frankly, he's not going to know we exist unless you have one of the small percentage of really aggressive advisors who actually looks at the AIP fund list because they get access to that and is doing his own research to find us. So like getting on that platform didn't all of a sudden, my phone didn't start ringing with all these investment advisors wanting to invest in us. It just brought us to the table that now when an investor wants to invest with us or a wealth manager wants to invest their clients' money with us, now they have a vehicle to do so and they can oversee your investment and do the proper allocations and see the proper reporting.
So I have a follow-up then. So why not just go to them and invest in your funds through them? Because then you have kind of you have everything at one place instead of directly. Is there a benefit to going with you directly instead of going through them?
Is there a benefit to you?
Yes.
Okay. So the benefit to going directly to us versus going to your advisor is really simple one. And I apologize if we have any financial advisors in the room, but it's that you don't pay your financial advisor. And that's the short answer, right? So if you go to your advisor, and there's a reason they get paid, right? They bring you value. So, if you come directly to us, there's one, and this is a really important point, I'm going to deviate a quick on your question, is all of the returns we talked about are net absolute returns. So when we say we generated 15.02 in lending fund, 12.5 in each growth, that's the net return to you. No fee, no expenses, nothing. If you invest through your retirement account or through Schwab and you have an annual account fee, we pay. It's an absolute return. So if you invest through your advisor and he charges you a 1% management fee, he's going to get 1% out of that return. That's the simple reason, not to, right, at the end of the day. Now, if your advisor was the one who brought us to you, of course you do it through your advisor. And we have advisors like Webb Youngs, who a number of you work with, who does bring us investors. So he's vetted us, he's done his research on us, He's comfortable with us. He's done all his homework, and then he comes to his investors, and many of them didn't even know we existed. And he says, "Hey, we're going to allocate 5% or 10% of your money to this strategy or this fund." And then, of course, he deserves to get paid for doing so and bringing you these alternatives. So that's what we've been doing, is going to some of these advisors like Webb Young's and building relationships so they can bring us out to their advisors directly. And it works great for him, for us, and for the investors, that you didn't have to do your own homework of coming to our dinner and learning about us and trying to vet us. He did all that work for you. Great question. Yes, sir.
For the small investor, what's the
Minimum investment. Great question. So in the DLP notes, which is the fixed return investment, that has a $100,000 minimum. The other funds have a $250,000 minimum. Now, important comment to make is when you see the minimum account balances, that's your account balance with us. So that's not in one specific fund. So example, you could say, I want to invest $150,000 into the DLP Income and Growth Fund as an equity investor, and I want to do $100,000 as a note investor. You didn't hit the $250,000 minimum in the Income and Growth Fund, so your total account with us is $250,000, and that's okay. Another interesting point to that is, let's say right now you had $200,000 with us in one of our funds, and you said, "Hey, Don, I want to do a $50,000 note or $100,000 note." We would pay you the rate based on your total account size with us. So we look at you as a whole. So if you have $250,000 with us, but only $50,000 is in the note, we'll give you the higher rate. Or if you and your wife and your kids, your family has $1 million with us, and only $100,000 is in a note, we pay you the $1 million rate. So we give you the highest rate, and as your investments grow with us, we'll bump your rate up. So if you get to the next category, we increase your rate. Another important item to mention, so right now, if you had $250,000 with us in a fund, you can invest any amount of money into another one of our strategies. So if you had $250,000 with us in the lending fund, you say, "Hey, I want to go into this equity fund too," you can invest 50 grand or 100 grand in there. There's no specific minimum. Also, once you become an investor, you don't have to wait till you get to 50 or 100 grand to invest at a time. You can do what some of our doctor clients love doing this. They just mail us checks randomly, and we'll get a $7,000 check, and we just add it to their account. And they use it kind of like a money market account. Instead of letting the money sit there earning nothing, every time they have 10 grand free or 5 grand fee, etc. A couple of the investors in the room have us set up an automatic ACH with them where we draw $3,000 a month out of their account or $5,000 a month account, and they're just adding to it regularly. We're very flexible in how you do that. It does not have to invest big chunks of money at each investment. Great question. Did we gather up the raffles? Looks like they're counting in the back. Larry, you got them? There he comes. All right. I think he's eating back there. This is Larry Hicker now. Many of you know. So welcome, Larry. I don't know what he's doing behind there.
He was hiding from you.
Yes.
He can't see me back here.
Let me pull up the raffles. That'd be good. First raffle is going to be for a $100 gift card. This is going to be for any prospective investors. And then the existing investors have a secondary raffle for this vacation. So we'll start off with the gift card. I just did the drawing. Okay. So the drawing for the prospective investor is Emma Kramer. There we go, all the way in the back. Larry will take care of getting your gift card. So congrats. And then the winner of the vacation is Z. Where is over there? There he is. So this, yes, where this is. This is in Florida. If you don't know where that is, it's near Fern, about a half hour north of Jacksonville. This condo, it's amazing community I've ever been in. It's about a 1,000-acre community, 10 restaurants, 3 pools, golf, amazing golf. It's an amazing place. I stayed there for Thanksgiving. They're setting up Thanksgiving Thanksgiving, and we loved it so much we bought a condo while we were this kind of renovation. It actually gets done tomorrow. So you're actually one of the first guests there. So enjoy and congrats again. All right, everybody. So that's it. I will be walking around with many of our team members. Can everybody from DLP quickly stand up? Stand up. So again, employees. Sorry. These are the real estate suites. Barry DeGroat, our general counsel. Matt, our controller, and our video marketing instructor. Right now, he's a leasing machine, leasing up our properties, generating great occupancy. Did I miss anybody? Mandy's in the.
Carolyn.
Okay, I didn't see you. Kate, our intern. There's we'll be walking and answer questions. Of course, Brian is one of our funding specialists. In here from Arizona. One of our dinners. So please talk to them, voters, and I'll be out with anybody. And
Yeah.